Hello, good morning, good afternoon, good evening, what's up? Whenever you're watching this, it's Tom Toole here, coming to you with episode number 21 of Tom's Take, where we're going to talk about a major financial change coming down from Fannie Mae that's going to affect a lot of people. And it has to do with debt-to-income ratio. So what debt-to-income ratio is, before I get into the change, it's the allowable amount that you can get approved for mortgage financing combined with your current monthly debts. So right now, as of today, the allowable debt-to-income ratio per Fannie Mae is 45%. So I did some quick math up here for you. If you're making $5,000 a month at 45% based on today's numbers, you're eligible for up to $2,250 for an allowable housing payment and for all your current debts. So think credit cards, car loans, student loans, any sort of installment loan, that's what's going to be factored in there. As of July 29th, 2017, that number's jumping up to 50% allowable debt-to-income ratio, or DTI. So that's going to mean an additional $250 that you can use towards a housing payment. Now, $250 may not seem like a lot, but when you look at affordability in terms of a purchase price, based on 4% rates on a 30-year fix, that $250 a month gets you another $65,000 in your purchase price or affordability. You heard me right, I wasn't joking, $65,000. So all of a sudden you're looking at a home that's at $300,000. Now you can buy a home for $350,000, $360,000, $365,000 if you really need to stretch. That's going to give buyers a lot more opportunity to buy the homes they want and get into a property where they can be long term. And obviously the longer you can stay in a home, the better financial position you'll be in, both from an equity standpoint. The loan will get paid down a little more. You won't have to move again, and obviously there's costs in moving. So this is a really positive piece of news for buyers, especially a lot of the first-time buyers that haven't jumped into the market yet, where they were priced out of a lot of entry-level properties. This is a big change, and it's really going to be a positive here. So obviously this is good news for buyers. What does this mean for sellers? So for sellers, this means that we're not going to have these really tight ratios anymore. Buyers should be able to buy your home a little more easily, so that home that was priced at $350,000, $360,000, that people were sweating a little bit because they knew they were right on the edge of qualification, now they're in a more comfortable position. Or you get someone who knows their income's going to go up, they're on the right career track, they want to buy into a higher priced home to be there long term. So this is really going to help not only buyers but also sellers. Now the CFPB, the Consumer Financial Protection Bureau, their recommendation right now is not to go any higher than 43% on a debt-to-income ratio. And what we're seeing is that the practices in our market are actually catching up with the policies. So the CFPB, they tend to be a little conservative. They're looking out for the consumer's interest. All good, no question. But they're not consistent with Fannie Mae policy. So in those cases where someone had to go up to 45 or now to 50, these loans really get scrutinized. They're looking at all the tax returns, bank statements, credit score. It's going to be thoroughly vetted, which is the reason why debt-to-income ratios got lowered in the first place, because back before the housing bubble burst, if you had a pulse, you were getting a loan. There wasn't that verification process that happens right now. So the practices are going to be there and the protections are going to be there so that this doesn't hurt people long term. Now the other interesting piece of news from the CFPB is that, and a little archaic to me, but this is what happens, is they finally came out this past week and said they're going to allow mortgage lenders to share the closing disclosure or the settlement statement with real estate agents without having to get that third-party consent that was typically needed. So what that's actually going to do here is not only do we see a major change from Fannie Mae, but we also see that the settlement process should be a little more streamlined and efficient. Previously, what was happening is a lot of lenders didn't feel they were able to share the closing disclosure with the real estate agent, and these things ended up being wrong. NAR, the National Association of Realtors, did a study that when the realtor is not involved in looking over and reviewing the closing disclosure before it goes to the buyer and the seller, there was a lot more corrections being made if the realtor wasn't involved versus if the realtor and the agent could look at it and review everything. So we're seeing that things are getting a little more loose in a good way because they're looking out for the consumer's interest. This is going to help a lot of buyers. Think millennials, think first-time buyers, people in their 20s, people in their 30s. It's going to allow them to buy a little more. And hopefully the process is going to get a lot easier for them with all these restrictions that were put on the market after the bubble burst. If you got any questions about this is really technical stuff here, very important. Connect with us on social, post a comment below. We'd love to connect with you. Or if you got a topic you'd like to see us cover in future episodes here of Tom's Take. Thanks so much for watching. I'll talk to you next week.